All right. If I can figure out current assets, I'm home. If I know total assets. Well, which equation is going to give me current assets? This is equation for net working capital, right? Using that, current assets is current liabilities plus net working capital, which is 1800 plus now 4100. And the answer is simple. NFA equals total assets minus current assets, which is done. Again, simple. What do I need? And what are certain definitions or identities that's going to give me that? We already did that. I'm not going to talk about that yet. Before we give a break, let's start talking about income statement. This is a statement of revenues and expenses. Two principles. Recognition principle. When do you recognize that? Unlike cash accounting, in the modern accounting, we recognize what we call accruals. The cash doesn't have to be in your bank account for you to recognize the sale. I sold you a computer and you pay me $100. Fine, that's a sale. I recognize. I sold you a computer and you said, you're going to pay me $120 in 2 months. As long as I have confidence that you're going to pay me that money, the sale is made and revenue is recognized. I haven't gotten the cash yet, but I'm rather confident that I will. In fact, the official definition of the recognition principle is that the sales process is essentially complete and probable that revenue is going to be collected is almost certain. It's something like that. You can read it in the book. That means if you're not sure that you can collect, you're not going to recognize. And sales process is going to be complete when the product is shipped to the customer, not delivered to the customer. So I don't know if you ever noticed, you order something from Amazon, until they actually ship, they don't charge you credit. They don't wait for you to get it. The shipment itself is when the sales process is complete. That's why they charge you credit. Sometimes you order something that comes out of mainland China, and to make things cheap, they actually ship it, literally ship it. They put it on a ship. It takes, about a week for that ship to cross the Pacific. By the time it gets to you, it's 2 weeks. But they still charge your credit cards at the time they ship, not when you get it. The second one is matching principle. The revenue recognition principle is for revenues. Matching principle is for expenses. You match expenses made to the sales recognized. So you sold 100 new computers by your cost accounting people. They tell you that it costs us $5,000 to produce those 100 computers. And each computer costs what? $5. So I'm going to recognize the expenses as soon as the revenue is recognized. In fact, in accounting we call that cost of goods sold for a reason. Not every expense is matched to a cost. There are certain things to a revenue. There are certain things like the overhead. Whether or not you sold anything, you're going to pay rent to your headquarters. You're going to pay your CEO their fixed salary, whether or not anything was sold. You're going to make expenses on research and development. But those are the main principles. Now, the way income statement is organized, again, it's organized with a view towards telling a story that gets deeper and deeper. First, we look at kind of a general stuff. And this is called the top line. You have revenues. You have cost of revenue. Sometimes it's called cost of goods sold, okay? And the difference is gross margin or gross profit, I'm sorry. Gross margin is something else. Now, that number in and of itself is interesting. Why? It shows me how much money the firm makes before we have to worry about all the other stuff. I mean, technically speaking, we're not going to do it here, but gross margin is going to be gross profit divided by what you want to call revenues. For each dollar of revenue, how many cents do you get to keep before you worry about things like overhead, taxes, financial costs, and others? Example, I'm going to do downloading financial statements in the second part, but you can do a quick look. If you go to financeyahoo.com, let's look at Starbucks. So when you buy that $6 caramel macchiato, or is it still $6? I don't know. I never put anything on my coffee. To me, if God invented coffee to be sweet or milky, he would have done it that way. And I'm basically an agnostic guy. It's not even, it has nothing to do with religion. Sometimes I call God the divine programmer. I actually believe that we live in a simulation, computer simulation. You're the AI in that simulation. And oddly enough, we're going to create our own AI. So if that's possible, Who is to say that we're not in AI in somebody else's simulation? Financials. I know I don't discuss religion here, and I don't belong in any organized religion. I believe in what a version of what Groucho Marx would love saying. I wouldn't want to be part of any religion that would have me. Somebody asked him, "Well, why aren't you part of this country club?" He says, "I wouldn't want to be in a country club that would have me." If you know Groucho Marx, that means something. All right. Their total revenue, 32,250. Cost of revenue, 28 or 23,839. Gross profit is 8.3. So for Starbucks, I think 2022. Let's see. Or trailing 12 months, but it's good enough. Eight, 3, 7 more. Man, that's all the lattes. Gross margin. I'm going to multiply it with 100 to get percentage. About 26%. So for $6 caramel macchiato, Starbucks get to keep about $1.50 before they worry about anything else.